Last week, when I put the technical target of Nifty at 4,700 to 4,750, I had secretly wished that it doesn't come good. But currently at 4939, events continue to point Nifty in that direction. Election results in Greece and France are ominous, not just for Euro, but for the global markets at large. As recent headlines from Bloomberg illustrates, China stocks fall most in 5 weeks on export slowdown concerns, or Japan stocks drop as Greece fuels Euro exit concerns, or Aussie dollar falls towards parity on Greek concerns. We live in a dangerously interwoven world. Even before implication of the voter revolt could sink in, the only Wall Street biggie standing after the 2008 crisis, JP Chase, admitted to a loss of $2 billion in their chief investment office, resulting from taking large derivative bets in the credit markets. It's not the loss itself, which JP Morgan can cope with, but the regulatory fallouts on the banking sector that scared the hell out of the street. As if that wasn't enough, India's IIP growth for April came in at a dismal minus 3.5%, much below the estimates. The degrowth was broad-based, but capital goods and infrastructure were the chief villains. Further evidence that the investment cycle has turned turtle. Tax authorities' saber-rattling with the foreign investors continue, with reports of retrospective claims in high-profile deals, including Vodafone, adding up to 40,000 crores. Corporate results, even in the face of inclement weather, put up a reasonable show. In this rather depressing scenario, a couple of silver linings are beginning to show up. Brent crude is down to $112 per barrel, down from about $122 lately. If it sustains, the 9% price drop could make a difference for India. Indeed, the entire commodity space has cooled off considerably. Major commodity indices are down by about 10% over the last 12 months. That is good news for a resource deficit nation. More importantly, it can provide some maneuvering room to the government to increase fuel prices later this month to reduce the fiscal deficit, as also to RBI to persist with the cycle of rate reduction despite inflationary repercussions. In fact, I believe the RBI could surprise the market again by a deeper than expected rate cut, or a rate cut combined with lower cash reserve ratio for banks, even before the next scheduled meeting on 18th June. Given that the market is near the lower range of its historic valuation, and that RBI can surprise on the rate cut, Percentage Play deems it unwise to go short at these levels. So we propose to be largely on the sidelines next week, except in our pair fund, where we expect to see more action even in this choppy market. So here is how we are thinking through next week. For the Quant Pair Fund, having closed 2 transactions in profit last week, we begin with a clean slate. Our outperformance with Nifty continues at around 34%. A number of new pairs are in striking range, mostly in the banking sector, of which we certainly hope to catch a few at prices we like. Watch out for the real-time alerts. In the Comparative Value Fund, in line with the falling market, our absolute return declined last week to around 6%, but the outperformance widened to over 16%. For next week, we'll be looking to lighten our exposure should there be a rally in the market on rate cut expectations. On the other hand, we are on standby to pick up rate-sensitive blue chips should Nifty move closer to our target levels. Thank you.